As opposed to a refinance where the money is sitting in your bank account and you're paying a mortgage off on it, the home equity line of credit is money available to you that you're paying nothing on immediately. So it's like there's a mortgage portion and a line of credit portion, and the line of credit portion is just there. You're ready to buy, you pull it out, put it down as the down payment, and then you start paying interest on it. And then some banks offer you the opportunity to change it into a mortgage segment. Which is, it's great for those clients who are like, I want to invest, but I want the right investment opportunity to come my way. And when it does, I'm ready to put the down payment on it, and I know that I can afford this much of a mortgage.
And it'll grow as you pay off your mortgage, it'll grow, that HELOC. So let's say you're not ready right now. For example, with some clients, we'll maybe start that HELOC out with $1,000, just throwing a number out there. And every time, you know, as they're building, you know, equity into their home, that principal is going now onto that HELOC, so they can eventually, let's say in 5 years, I want to buy my first investment property. They'll have more money in there to use at that time when the time is right for that.
Yeah, you usually see about $50,000 by that time because you take advantage of all the prepayment opportunities that you have, right, in a mortgage. Do you know your prepayment opportunities that you have in a mortgage? You have like the ability to increase your monthly payments, the ability to put lump sum payments towards your mortgage, your principal, and the ability to increase it every year, one time a year for the whole year. And the range goes from 10% to 20% of your original amount, which is great, right? Depending on which lender you go with. So the reason I put this up is because I just want you to sort of understand the difference in refinance, second mortgage, HELOC, and reverse mortgage, and what makes sense for you at the end of the day. It's a lot of information, I understand, but at the end of the day, the best are the refinance and the home equity. And then second mortgage comes in only when you know that this is a great opportunity, you know you can afford it, you know that your rent will cover it, and it just makes sense. So we would do the second mortgage. The rates are quite high on the second mortgage, there's lots of fees as well. But like I said, I've had many clients who've done it, and they love it. Because now they have an investment property, they've taken advantage of the investment, and then they actually end up paying the second mortgage off, right? And sometimes the fees make sense, but it's not for everybody.
Yeah, and the second mortgage as well might be an option. For example, some mortgages don't allow you to really break unless you sell the property. There's some special rate ones. So in that case, I had a client where that was one option for them, was to do a second mortgage, because to refinance, they were at a low interest rate. It made no sense to break that mortgage. They were only 2 years into it. So that's where we looked at that second mortgage and looked at the numbers and said, does this make sense? At the time it didn't, because prices had gone up a little bit, but I mean, we've got that in our back pocket if a property, the right property comes up.
Now I have, thanks for the example, but like I also had a client just recently closed on a house. She's a realtor, she had her home. Her home was worth about $650,000, $700,000 right now, and she had an investment opportunity that came up. However, with any investment, so if it's a rental, you have to put 20% down. That's just standard. She didn't have the 20%, she had 5% down. So we did the reverse. We made her primary residence that she has right now as a rental. We put the rental amount on it, did whatever calculations we needed on that, and then the new purchase was going to be her primary. And so she could put 5% down, it was an insured mortgage, and now she actually closed last week on it, and she's got 2 homes now. And it made, so sometimes you'll be like, it has to make sense to the lender. She moved from a bigger house to a smaller house, why? So the case was, she can't afford to live in the bigger house, so she will rent that out. She's getting more rent, she can cover the rental costs. This house is smaller, she can afford it, and it just makes sense. She got it. She's her first step to the next level, and she wants to get another house in the next year, and I think with the way she's going, we can do it, right? So we will work with you and position it in a way that it makes sense, right? We've had clients where they have a primary residence and they have a finished basement, but they're not renting it out. We will set it up in such a way that they're like, hey, if we could rent out the basement, we'll get market rent appraisal, rent it out, see how much you can get, and this could give you an extra funds to buy your next home. So it's just being creative, and we've learned to be very creative. I will send this to Esther. She can send it out to you guys if you need that information. This is where we were talking about maybe second mortgages, breaking your mortgage, or anything else that would help to get you to the next level and how much it affects. There's two kinds of prepayment stuff. There's prepayment penalties and prepayment privileges.
My bad, okay.
Didn't sound right, but. So, as I mentioned, when we have the privileges, you can increase your monthly payments, lump sum prepayments, and payment schedule flexibility. This is when she mentioned the HELOC and how the HELOC will increase over time. It's because you've done these three things. You've tried to pay down your mortgage as much as possible, and now you have access to an amazing HELOC, and you can use that towards your down payment.
And it's not costing you anything because you haven't used the funds yet, right? So it's just sitting there.
Prepayment penalties. This is where we would look at the cost of breaking your mortgage, transferring you to another institution to get a line of credit if your current institution will not allow you to do so. We would look at it in the whole picture to make sure that if it makes sense and if the penalty is doable, makes sense to do it, everything, all the numbers are working to your favor, we would do it, okay? I've had clients who just bought, I think it was last year, December, they bought a rental. The rental income at that time wasn't very high. They were getting about $2,000. They had to put $100 every month into it. They did. They just came back, I think last week, to do a refinance because their property value had gone up, and we were able to do it. But we had to break her mortgage to do it, and we could. It just made sense. With the amount she was able to pull out, she's now able to keep that home and put a down payment on a pre-construction. So that's another way that you can use your money for future purchases as well. I feel like I'm losing some of you. Let me know if you have any questions. Yes?
So if, say I find a pre-construction that comes up and it makes sense for me to purchase, I can pull the money maybe out of the house that I own now, and then possibly assign that pre-construction.
A lot of, yes, you can definitely do that. So we've had clients where they put down 10, 15%, like it's 5, 10, 15% depending on the pre-construction. And then just before closing, 2 or 3, 2 months before closing, they've assigned it and sold it off. They've already made their money. So they bought it for 400, they sold it for 600, they put down a certain amount. Now they're just making 200 grand, right? So those pre-constructions are great, and you can take advantage of the equity in your home to be able to do that. And you're just banking on the fact that in 3 or 4 years, that house will be worth more. Make sure you are able to assign it. That's
I was gonna say that, keyword.
Keyword, make sure you can assign it. I have a client right now who's stuck. I'll be very honest with you. He's stuck. He was told he could assign it, he can't. He's got 15% down, and we're trying to find him a mortgage right now. So, trust me, I'm like putting my hair out.
Just do your homework.
Yes.
Right?
Yeah. And work with your, that's the thing, right? He decided to do it on his own, he didn't work with an agent. Right? Because I asked him, I said, what did your agent tell you? And he's like, I didn't work with an agent. Well, I'm sorry. Yes. I can't help you. I can only try to get you a mortgage now, right? At the end of the day, so. Because they do make sure that you're, they read everything and make sure that you are put in a position that is right for you, right? So this is what I was telling you about, how if your rate is like really low, look at the penalty for that, right? Because you're going from a really low rate to a higher rate, so the breakage cost is very low. So sometimes it makes sense. It's not always gonna make sense, but sometimes it makes sense, and we will work your numbers out. So basically, if the mortgage is $500,000, your current mortgage rate is 1.92. Obviously, it's a fix, because there's no way your variable rate will be that. 5 years, made in 2020, 2,400 is your breakage cost. Actually,
How do we get that interest rate?
Sorry?
How do we get that interest rate?
We're gonna pay somebody, raise some hands. Does anybody know what prime is right now?
6.95.
I love it. You guys are great. Very educated. I love that. That's perfect. It's true. Yep. I know. The faces. Rate went up yesterday by a quarter, so which means prime went up from 6.7 to 6.95. The best variable rate that we have right now is prime minus 1.2 on an insured, which does not make it great. Right. So if you are looking, the best thing to do right now would be stay into a fixed for 3 years and hope for the best in 3 years. So, and fixed rates went up too because bond yields went up, so.
What's a 3-year fixed rate?
I get 4.99 on insured and 5.14 on non-insured, like insurable under $1 million. Yeah, go ahead.
Question, I know you talk a lot about the lower cost of breaking a mortgage, right? So, $2,400. But I think a lot of people are also looking at, after they break the current mortgage contract, they are going to sign a much higher rate, right? Yes, they have access to alternative equity, but the rate is much higher. So I think for a lot of investors, to me, it's a one-time cost of breaking a mortgage, right? So I guess the question is, they will look at, okay, now that I have to be paying so much higher rate by breaking this contract. So my question is, would not a second mortgage be a better option for some of the investors? And obviously not for everybody, but a second mortgage, because at least they can keep their first mortgage at a lower rate, right? And that's very comforting for everybody. And then the second mortgage that they can get, I still get some equity, but only the second mortgage they're paying at a current market mortgage interest rate.
So I'll tell you what the second mortgage rates are.
It's not just the rate, there can be fees associated
Yes,
as well.
so it's about 7.49 with a 3.24% fee.
Wow.
So I guess again, it's a case by case, and that's
Exactly.
one-time numbers.
You're
and just-
100% right,
That's a
Esther.
1-year term.
Yeah,
Yeah.
it's 1 year.
Yeah.
You're 100% right. This is why like I said, every client is unique. We will never put you in the same box because we will work with you on what works for you. For this, like I said, for that realtor client, it just made sense for her to do it the reverse, right?
Yeah.
Your primary residence will be your rental.
Yeah.
The other one, we broke her mortgage. We broke her mortgage, refinanced it at a higher rate, still made sense with the rental income that she was potentially getting from her basement. So every case is unique, and she bought a pre-con. She's already put it in. She's got her pre-con. It's gonna pre-construction. It's gonna close in 2025. So she's set, right? It just made sense. We've had clients who actually have rented out their basements and said, you know what? It just makes sense for us. We can barricade this door. Client has access. Their tenant has access to the, backyard and everything, and they're good to go. Every case is unique, and we will work with you. Just make sure that, and it doesn't have to be us. Whoever you work with, just make sure that they understand your situation, what you're trying to accomplish, where your goals are at, and that helps. Because if you don't have a clear picture, it's hard for us to give you direction, right?
What your risk tolerance is as
Yeah.
well, right? I think sometimes clients, for example, going back to the variable rate last year, some were ready to, they were like, I can do the risk, but who knew? And nobody could project what happened, right?
4.95, that's
You
how
know,
high it's
so it's one of those things where you have to really know your risk tolerance.
Now Julia has something for you.
Oh, we've got some tools. I was just gonna show you, as actually newly discovered tools that we have as well for if you're looking to, sorry, I just looked at it. Pardon me. So there's some tools that we have available as well. So if there's a property you're interested in and you wanna crunch numbers, we can essentially add all the numbers in here and analyze the purchase. We can look at an amortization schedule, also add CMHC insurance if you're, with this, I don't know why that's there, to be honest with you, because 5%, I'm like, I don't know why that's there. But anyway, so we can look at a property and see it, does it make sense for you, right? So it's really important for you to not just fall in love with the property because someone's telling you it's a good property, but look at the numbers, look at what, put all your costs in, appraisal costs, title insurance, all these costs, operating costs, what it will be, and what kind of rent that you'll have coming in, if it's a first, second mortgage, whatever it is, and we can essentially put the numbers in and look to see if it makes sense for you. Another great tool is return on investment. So this is a great tool to have when you're looking at investments, and you know, you can punch in as many years as you want. Obviously when you're starting year one, but you know, if at year 9, for example, your return on investment isn't, sorry, let me just show you the chart there. So you just put all the monthly totals and such. First year, and it'll give you a return of investment. So by the 9th year, for example, sorry, I don't have any numbers in here because it is quite new to me. The example that we were given at that point, the return on investment had gone quite low. The equity in the property was high. So at that point, you want to take that money out, right? Take that money out and reinvest it. I mean, it's not necessarily going to take 9 years, but you kind of want to look at every year that you have an investment, is it making you money or is it costing you more money? And can that money that's in it make you more money by buying another property?
I
Are-
would say this.
Yes, go
I'm
ahead.
sorry, are these tools accessible by us?
We have these tools.
So we would, yeah.
Yeah, so
okay.
you can reach
When-
out to us, we can just crunch numbers.
Gotcha.
You don't need to sign on any dotted line, we're not gonna take blood or anything, so. But yeah, they're great, and I saw some examples today, and it was really, it was nice to see the numbers, because numbers mean so much, right? And at the end of the day, it was interesting to see, you know, some years a property is gonna cost you a couple thousand, you know, in expenses. Another year you'll have to do air conditioning, this and that, so it'll kind of assess there, and at that point, you'll be able to assess if you need to, you know, you're not making as much money, what do you need to do to make more money? You don't wanna sell the property, but you wanna maybe buy another property, right? So those are kind of the tools that we have available to us as well.
Just to give you an example, so 20 years ago, my parents bought a place. A rental property near the universities, $198,000, super expensive at that time, we bought it. In the beginning, rent was great, everything was great, then we had that little rent lapse, right, where rentals were going for so cheap and stuff, so at that point, my parents were putting money in. However, they refinanced it, bought their own home first. Then they refinanced it again, and at that point, when they refinanced it, there was a shortage, so they had to put $100 in. At this point, it's carrying itself because rents are great, and so it's doing really well. Worth now $650,000 to $700,000 depending on which realtor listed, right? That's one investment that really worked out. I bought an investment in 2020 in Windsor. I fell for the let's buy an investment property, the rates are so low, right? And truth be told, there was already a renter in there, and the rent was like super low, it was $1,500. $1,500 on a $496, it does not make sense. And as a mortgage person, I should know this, right? But what I was counting on was value is gonna increase. I sold it this year. I still made money, right? So even if it's a mistake, an investment, like I have mutual funds, I cannot tell you I made 20 grand on a mutual fund for the last 2 years. But I can tell you on that property, be it a mistake or not a mistake, be it whatever reasons I sold it for, I still made about at least close to 20 to 25 grand clear after all expenses were done. So investing is never wrong when it comes to real estate, just make sure that you have the right intention. If you think about rate all the time, and if you think about, you know, will this make sense for me in like 2 years, then you're not thinking investment, you're thinking flip. An investment is a long-term hold, right? You take it and hold it. The only reason I sold it, I have reasons for it, but it is a long-term. So if you think, oh, you know, the rates are high right now, I don't know, you're not thinking investments, you're thinking flip. So make sure you understand that difference and make sure that you realize that when you're doing an investment, like my parents did, 20 years, they bought 3 homes from that one home. Constant refinancing. Esther? Yes, ma'am.
I'm gonna say that story about 20 years ago, that story is probably very difficult to replicate right now.
Well, this is what I just said, like, that's why I said the Windsor property, right? I
Yeah.
mean, 25 grand within less than 2 years.
Yeah. But I also
Right,
wanna add
so-
that because the rates are so much higher now, and a lot of questions we get from investors are like, you know, the rates are so high, how am I gonna afford, and the rent is not gonna cover it, it's gonna be cash flow negative, right?
Okay.
That's a comment that we get all the time from our investor clients, right? So they're really worried about having to pitch in for the shortage, right? So I think one way to look at it is particularly in Guelph area is that we have great student rental market here.
Yes.
So I know Dean familiar with that as well. So we rent, for student rentals have gone up significantly, right, for the past year. Average room was renting for $750, now it's $900, close to $1,000, right? So I think if we look at different ways of how we can improve our rent, that's gonna offset some of our mortgage costs, and then that's gonna make our investment probably more sort of long-term.
But I also think that even if you had to put $100 in, let's say for example, you had to put $100 in every month on your investment, how long will you have to do that for? 1 year? After that you won't, because now you've got equity, right? You've got something in your home, you've got a different renter coming in, you've got so many different opportunities that sort of satiate that $100 that you put in. You also have to look at the long term, like if that $100 every month is about what, $1,200 a year? $1,200 investment on a property that's gonna give you back a rate of return that's gonna be fabulous at the end of it. So investor mindset is a very different mindset. You
Yeah.
have to be in that great mindset.
Yeah.
It's sort of, I'll reiterate this, I am a mortgage agent, so
There you go.
I will disclose that. Also a real estate investor, and when we talk to clients, again, it's not even $100. If you have to put $500 a month, then that's $6,000 a year. But if you have a $500,000 property, and I'm from Kitchener, in the Kitchener area, historically in the last 40 years, appreciation has been 7%.
Yep.
So you do the math. I mean, you can't buy a $500,000
Nope.
property in Kitchener anyways, but if you do the math, every year you are gaining more equity in that property than you were actually putting in. So it is an investment in your future, right? And then at that 2-year, 3-year, 5-year point, whatever makes sense for you,
You get your money
do
back.
that refinance.
There you
pull
go,
that
you got
equity
your
out.
money back.
And that 500,000 isn't going, to garbage, it's going to the property. It's like putting it into a savings account, right?
Well-
You wouldn't think twice about that.
As well as
Watering your garden.
as well as your
waiting for the
principal
rain.
protection, right?
Yeah.
That's, and that's another whole ball of wax is, the part of the principal that you're paying.
100%, and it's my mom says it, right? She's like, you can't always wait for the rain. You gotta water your garden sometimes, and once you do, the rain will come, and you will see that it makes sense, right? So, yes.
I have a question. So what's the best option? Refinance, or if you have a low mortgage rate right now, because if you're refinancing, you're going to higher mortgage rate, right? So if you have still like few years to go until renewal, so is it better to apply for home equity?
Yeah, so we had discussed that, sorry, yes.
Sorry, I
No, that's okay, that's totally okay.
missed it,
So
yeah.
yes, we would, if you like the rate that you're at and you can get a home equity line of credit, we would definitely suggest speaking to your financial institution, see how much you can get for a home equity line of credit, and then wait for the right opportunity to come to use that as a down payment or a full purchase, because some people have enough equity that a home equity line of credit can cover pretty much a lot of the down payment. And yeah, so we would definitely look at your situation uniquely, of course, which makes sense. What makes sense is to better just lock it into a new mortgage, because sometimes that makes more sense, right? Refinance your property, this is how much you'll pay, this is how much you'll make, does that make more sense?
And is there still some products available which you get the mortgage, and the more you pay in the equity, you get the home equity line of credit grows up like this?
Exactly.
Is it still available, or
Yep.
regulation changes now?
Nope, so RBC, CIBC, BMO offer that product right now. Well, I'm not sure BMO, but yeah, they do offer the product where if you have a home equity line of credit already existing, the more you pay down your mortgage, the more you have equity in your line of
And
credit.
at what percentage of equity does
So right now, they've changed the rules to 65%,
Used to
right?
be 80 before?
It used to be 80, so if you already got the 80%, they'll probably scale it back a little bit right now because of the high interest rates. So let's say you got a house for $500,000, you had a $100,000 mortgage, so you were able to get $300,000 home equity line of credit. They will scale it down for you. They will call you up and say, hey, you know what, you've overused your home equity, we're gonna max it out at this, at 65%. The only reason they're doing this is because variable rates have gone up so much that's the interest on the home equity is quite high. So that it all depends, every lender is different and every client is different, so they will look at the whole picture. You can have access to the 300,000, if you're not using it, they'll just tell you that it's not 300,000, it's only 250 or 150, but that definitely banks do have it.
Okay, and the change from 80% to 65% applies to already existing?
They have applied to already existing. Now again, I only know this because I used to work at RBC. But like I said, every client is unique, so you have to talk to your, bank and see what they offer you.
Okay.
But yes, they did scale it back in 2021, I believe,
Okay.
yeah.
If you had a large home equity line of credit, like you mentioned, and let's just say for argument's sake, your house was paid off and you have a nice big home equity line of credit on it, and you used it for the full payment of a home, and you go in and you mention it, and you can go down to the lower mortgage rate, what you were talking with your banker. Do you have to go through the whole, because it's your own home equity line of credit, do you know if you have to go through the whole rigmarole of showing income, going through all the steps, going through that, or?
But yes,
Yes,
because
still?
at the end of the
Okay.
day, they wanna make sure that even, let's say you have 50,000, well, you'll never have 50, but $100,000 mortgage.
Yeah.
You should be able to still have an income to sustain that mortgage. Even if you have rental income, let's assume that the renter rent and now you have to pay for it on your own, you need to have the income qualifications to do it. Your rate will be better because it's like less than 65% loan to value, but
Now, Chris, was your question about whether if you were to use your line of credit, whether just
Income.
use that whole thing to pay, not
Pay
having
for
a
the home,
mortgage?
yeah.
Not to get a mortgage?
no, it doesn't matter. If you use your home equity line of
But you wanna
credit,
switch, sorry, do you wanna switch it into a mortgage after, is that, that's what I
To get a lower
understood?
rate, like,
Oh,
yeah,
Yeah,
so
yeah,
you
but
have a whole home equity line, let's say you had $1 million home equity line of credit, and you bought a property for $800,000. And so you did that, but you didn't like your rate of your home equity line of credit, and so you talked to your banker and said, okay, is there anything we can do about that for a better mortgage rate? And then they're like, okay, well, now we need these.
They will-
Like, are
they will
they
need
gonna
income
treat it like it's a
qualifications because-
first mortgage or is?
you've just spent $800,000. You
I
just
know, but-
$800,000
But he
on
has a
a.
mortgage, line of mortgage.
Yeah, but it's $800,000 on your line of credit. A line of credit rate, let's say it's just prime 6.95 right now. You're paying only interest on a $800,000 at 6.95. You're now converting into a mortgage segment. How do we know you can pay that mortgage?
But I just thought, because it was already
because it was
mine.
existing?
Because it's existing.
Yeah.
It's home equity line, like it's
No,
secured
agreed,
against my home.
100%. It's just
I
that.
can take it anyways and go to the casino. I just thought maybe the rules.
So
that-
when
that's
I used to be
right.
at RBC and we had clients who came in, have used their home equity line of credit and now want to convert it to a mortgage segment, we would try to get the best rate for them, right? In terms of your whole portfolio, what you have, what's existing, what's not. Your rate is based on everything, right? With mortgage brokers, when you're coming outside of your lending institution, we look at it differently, we'll have the whole income and stuff. But when you are with an institution internally, there are chances that they might not look at it, but when it's as high as 800, I've seen as high as 400, and they've had, can we need to see your income documents? Because you could be retired and using 800 grand, how are you gonna pay for it?
Actually, can I just clarify, sorry, I'm also a mortgage broker. If you're under a collateral charge, you can move it between your line of credit to your mortgage up to 80% of what you've been qualified for. You can't do it through a mortgage broker, you have to go to the bank and convert it.
Yep.
And there is no requalification.
No
So as long as your
requalification, but they,
original- As long as your original
There you
approval is the amount. So if you've gotten 80%, so your approval is at 800,000, and your property is worth more than 80%, you can convert it at any of the institutions without requalifying. Okay?
So would that conversion be sufficient for him to get for the next purchase, or?
So the conversion is just taking it
from
from
one
line
place to the other.
to making it a mortgage at a lower rate. If he's looking to do anything outside of that, then he has to
To requalify.
requalify. Okay?
But if you want a better rate, we look at income as well. I know that's because I've been there at RBC and I've done it. We look at income to see, okay, how are we gonna get you a better rate? Sure, if you have the ability to pay for it, we'll get you a better rate.
Talk to the bank, Chris.
And then it depends also on which company you're in. You can do multiples, like, so TD, you can do up to 15 mortgages. Also be really careful, guys, when you're using your primary residence, if you consolidate your primary mortgage with your rental, CCRA will not let you deem that as tax deductible.
Yeah.
So you have to keep these products separate. Otherwise, you're going to possibly get into an audit, and you'll have any of the interest that you had no longer deemed as a write-off.
Okay, so if we have investor has, sorry, it's a separate question. If we have investor has two properties and each one has equity. So when they apply for home equity for second one, like they already got one, they apply for the second, do they assess based on how much equity or they look at the whole portfolio as well?
So, let me get this straight, you have two investment properties?
So yeah, like if somebody has two investment properties, they already have one mortgage, two mortgages of course, and one, they already have home equity line of credit. And then now they are going to apply for the second property home equity line of credit, right?
Okay.
So do they assess how much the value, how much equity, and based on?
Everything, we
Or
look
they
at
look
the
at
whole
the
picture.
Everything.
We
But
look at the
still,
whole
it's still
picture.
possible, like people can do this, right?
Yes, depending on which lender you go with, some lenders not offering home equity lines of credit on rental properties anymore. There are some lenders that do offer it, and so it all depends on who you go with.
No.
And it would be requalifying the whole thing, because let's say you have a home equity line of credit, some lenders will say, okay, you have $100,000 available as a home equity. They use the full 100,000 and pretend like you're using it all, and then requalify you on that. So your HELOC opportunities are lowering every time you have a HELOC.
Oh, I see. Okay, can we go to different lenders than the?
100% you can go to
like
different
second
lenders.
mortgage, like as a second mortgage,
Yes.
right?
Yeah, you
But you
can.
get higher rate, right?
Higher rate, requalification again, you have to.
Because second position, right?
Yeah, yeah, 7.49 to 3.24% fee, so it all depends, if it makes sense.
Sorry, the fee is different than the interest rate you're talking about? Oh.
Second mortgages make sense if you are in a place where your rental income makes sense, your very low mortgage, and you love your mortgage rate right now, and you're trying to get more equity without breaking this, then we can look at a second mortgage. It's one of the last things that we look at, because again, we don't wanna put you in a place where you can no longer afford anything, right? Like, we wanna put you in a place where it makes sense, and you can buy another property and you'll be able to pay off the second mortgage very quickly, right? But yes, it's a whole picture.
Okay.
Yeah.
So the fee for like the second mortgages is very astronomically high. In the long term, when you kind of equate everything out, does it really make sense to kind of be in that position of a second mortgage?
It has. It has. For some, it has.
Yeah.
It like I said, it's not always. I've done once for one client, and they ended up buying, like I said, a pre-construction, did really well, sold it off. Not only did they pay off the second mortgage, they were able to actually put some money in their pocket and stuff. So it made sense for them. It's not always going to make sense. You can come to us and say, if you want a second mortgage, we will say no if it does not make sense to you, because the last thing you want to make you is house poor.
So it is better from the first place, like to select a lender who allows more, home equity on rental, right? Like you have to.
They can change the rules
They can
tomorrow.
change the rules.
Today you'll go there, they'll say,
Same
yes, you can
time,
do it,
yeah.
and tomorrow they'll be like, unfortunately, the bank has changed its plans.
Yeah.
So, we've had many times where we've had a client who had a home equity line of credit, and they just told him that this is it, you're not increasing it anymore, and we've stopped giving it up. So if you have it, yes, you have it. If you don't, or if they say yes, you can eventually get it, but then the rules change, you can no longer get it. Yeah, it's because.
So who's
No.
currently allowing second, home equity line of credit or rental, like major banks?
Sorry?
We can go through that after as well.
Okay.
Yeah.